Hey, good afternoon, everyone. My name is John Gemini, EVP of Production here at Angel Oak Mortgage Solutions. Thank you for joining us. We'll give it about another minute to minute and a half for people to get logged in. I won't say Happy New Year, but happy month end. So it's January 30th. Hopefully everyone's January has started off strong. I know we're seeing a pretty strong start to our January, and today we're going to cover our debt service coverage ratio along with our foreign national program. We'll get started here in about another 30 seconds. I'll introduce our subject matter experts and probably a couple familiar faces because they've been on a lot of these webinars over the last, God, I can't believe it, 4+ years. So that's just doing the webinars, let alone you guys have been here a lot longer. So but we'll get started here in about 30 seconds. People are still logging in. Thank you, everyone, for taking their time to join us here today. We're really looking forward to 2025 and the opportunities out there. I know, people are still wondering what's going to happen with rates. No one knows, but I think you've got to put your plan together if you haven't already put your plan together, and then work that plan. And if it doesn't work, work a new plan, right? We've talked about that in the past. So about another 15 seconds. A lot of people still logging in. We had a really, really high number of registrants for this webinar today, and hopefully that's a good thing for everyone really wanting to really round out their product assortment and become product experts on everything, not just government, but non-QM also. So, all right, we'll get started here. My name is John Gemini, EVP of Production. I'm lucky to be joined by two seasoned subject matter experts. Stacy Flanagan, please introduce yourself, please.
Hi guys, thanks so much for joining us today. I'm looking forward to hopefully doing some more business with everybody on the call. I am Stacy Flanagan. I'm in the Florida region and have been with Angel Oak for 11 years now.
Yeah.
Since I was
just tell it. What's that?
Since I was 20.
Chris Taylor, please introduce yourself.
Hi, I'm Chris Taylor. I'm out in Colorado. Been with Angel Oak about the same amount of time. I've almost forgotten. But really happy to talk to all of you and looking forward to you on our loans.
Yeah, and again, I'm John Gemini. I've been here, like Stacy, 11 years. So just between the three of us, we have over 30 years experience, not just in non-QM, but just with Angel Oak also. So today we're going to talk about our debt service coverage ratio program and our foreign national program, because our foreign national, probably about a few years ago, we rolled it in underneath our debt service coverage ratio. And I think we made it a lot more powerful product for the foreign national borrower. So everything we're going to do today is driven from our website. They're easy to use, easy to navigate website. This is going to be recorded. We will get this out to you hopefully before end of day tomorrow. And if we don't answer all your questions, we will have your account executive, we will have your account executive reach out to you as soon as possible to answer any of your questions. But before we jump into the debt service coverage ratio program, we want to do a poll, and we're going to launch a poll and see who has originated a debt service coverage ratio loan in the last 12 months. So let's launch this poll, see what we have. This is without a doubt, I know Stacy will and Chris will attest to this, probably one of the easiest loans in the mortgage industry to close. So, some of the stats we have out there, I think it's like 73% of the home, or what is it, 40% of the homes are owned by investment, and 70% of those are actually owned by individuals. I know everyone keeps hearing about these large corporations buying in and grabbing all this inventory, but it's still majority are owned by individuals. So, wow, okay. So the poll is 47% have originated a debt service coverage ratio loan in the last 12 months. 54 have not, and that's usually, this is the one where we get the larger percent have versus, has not, and that's pretty interesting. So almost 50-50 there. So, Chris, Stacy, you're going to take us through the highlights of the debt service coverage ratio, and let me get there for you. All right, Stace, take it away. Can't hear you, Stace.
How's that?
Better.
So those of you that have not done a DSCR, it stands for debt service coverage ratio, like John said. What this program is for investment properties only. And we're basically going to qualify the loan based off the cash flow of the property. Now, there's no income and no employment on the 1003. So we're not qualifying the borrower as far as income goes. There's no DTI on this program. It's based off the cash flow. How does the property cash flow? So this program, we go down to a 680 mid score. We go up to an 85% LTV, and the 85, we would need the 720 mid score to get to 85. We go up to 3 million loan amount, and our minimum loan size on this program is 100,000. We do purchase, cash out refi, rate and term refi. We also do what's called delayed financing. Delayed financing is somebody that has to purchase the loan. You know, maybe there's a backup offer, they need to close on it, maybe they've been trying to close on it, they didn't make it to closing, so they just have to pay cash or get a private lender, but they want to turn around and recoup their cash or pay off that 12% private right away. So we can do that right away, next day, and we're going to base that off the purchase price. Once they have 6 months seasoning, we can use a appraised value. But next day, if they want to do delayed financing, we'll go off the purchase price, and we'll also treat it on the LTV as if it was a purchase, meaning we're not going to hit you on your LTV for a cash out. On this program, we do allow short-term rentals. We go down to a DSCR of 1 down to no DSCR. What does that mean? So when you get the market rent back on the appraisal, so I'm going to talk about a purchase here for a second. So on the appraisal, the appraiser is going to do the 1007, which gives you your market rent analysis. If that market rent covers your new mortgage payment, PITIA, if there's HOA, so PITIA, if that market rent covers that 100%, that's called a 1.0 cash flow. So let's say our new mortgage payment is $2,500 a month. The market rent comes in at $2,500 or higher. That's a 1% or 100% DSCR cash flow. So that's covering it at a 1-to-1. Now, what if it doesn't cover it at a 1-to-1? So if you're at 0.8 to 0.99 cash flow, we'll still do that loan at 75% LTV. And if you're below 0.8, we'll still do that loan. We call that no cash flow at 70% LTV. So a lot of options, no matter what the cash flow comes in at, we do have an option for your borrower. Just kind of going down the bullet points on the screen. As I mentioned, no income, no employment, you leave that all blank. Angel Oak will do, guidelines say 5 loans per borrower. Chris and I don't listen to those guidelines. We'll do as many as you want to bring us. So I've done 8 packs, I've done 10 packs, I'm sure Chris has as well. If it's a good borrower, you know, we're going to look at the full profile on what we have from the borrower. So we're not going to limit that to just 5.
Yeah, no, Stace, can you hear me?
Yep.
Yep. So, no, you're right, Stace. I know, you know, I think it's about 20-25% of the loans Angel Oak closes don't meet our guidelines. And what Stacy and Chris will, and working with Stacy and Chris and all our other account executives across the country, they know the appetite for the loans we know that are going to perform well. I mean, Stacy 11 years, Chris 10 years, me 11 years. We've been here long enough at Angel Oak to understand what deals are going to get closed. So I think that's huge when working with, you know, Stacy's, Chris, and all of Angel Oak's account executives.
Yeah, and that's what's great too about having an AE that you can call and confide in and give us the full scoop. If if it's maybe not presented to us in a way that we can make it work, again, we know the underwriters, we know what Angel Oak likes, what they don't like. So use Chris and I, definitely lean on us to maybe restructure it or help you figure out a way to get it done if it doesn't fit exactly the guidelines. And as far as how many properties a borrower can own under this program, they can own unlimited amounts of properties. Now, it sounds like a lot of work, but if the properties are listed in a corp or an LLC and not on their credit report, you don't even have to put them on the 1003. So that's going to alleviate a lot of work for you and your borrower. First-time home buyers, we don't allow these. Dodd-Frank says DSCR can only be investment properties. So how do we do our due diligence to know that it's truly going to be an investment property? We're going to look at, do they own a primary residence? If they own a primary residence, when I get my pre-quals from you guys, I jump on Zillow or Realtor.com. I make sure that their primary is not listed for sale, because I don't want to catch it down the line. It's already gone to underwriting and you see that their primary is listed for sale. That's probably going to tell us that they are probably going to be moving into this subject property. So we want to do our due diligence up front for you just to make sure that it's truly going to be an investment property. Now, if they do rent or even maybe live with mom and dad, but they own other rental properties and they're just adding to their rental portfolio, that's fine. We get that. So that to us will tell us that it's truly going to be a rental property.
Yes, Stace, I want to interrupt you because Emilio's asking about, is this for the, because we talk about these a lot like it's for the experienced investor. Is this for the first time, not first time home buyer, first time investor?
Yes, absolutely. So somebody that's just trying to build their portfolio, just wants to dabble in buying a rental property, absolutely. They don't have to have any rental experience. This could be their very first rental property they've ever owned. And I know that's not true with a lot of lenders, so it's definitely a key point for us. Great question. We can close these in an LLC, S Corp, C Corp, or revocable trust. They can create that LLC today and close in it tomorrow. It doesn't have to be seasoned any length of time. We do these now, permanent resident alien, that's somebody that has a green card. But we also allow these on non-permanent resident aliens. We see a lot of these with the e-visas in the US. So we do allow those on this program now. That's kind of a recent add-on the last 8 months or so. We also allow gift funds on this program and any of our investment programs. We allow gift funds. We want to see 10% of the borrower's own funds plus 6 months reserves. And we only require reserves on the subject property, none of their other homes that they own.
Yeah, that's huge, Stace. That's really, really big. I mean, so yeah.
Yep, so gift funds are allowed. And the other thing too, we only season our funds for 30 days. So close your ears. So if it's mattress money or any sort of money setting somewhere, throw it in the bank, let's get it underwritten. Just don't supply the assets until they've been seasoned in the bank for 30 days and we don't see that large deposit.
Yeah. Thanks, Stace.
You're welcome. We also allow interest only. Rates are definitely coming down. Actually, our interest rates right now, if you price out our DSCR, I just had a broker call me yesterday and they're like, your DSCR rates are lower than Fannie and Freddie right now. And I'm like, I know, but we still have the interest only option available as well. It's a 30-year IO, interest only for the first 10 years, if that's something that they want. But again, our interest rates are pretty good on these programs right now that they may not want the interest only, but it's available.
But Stace, before I forget, because we talk about, the debt service coverage ratio 1-to-1 or, a 1 to a 0.8, do you qualify the borrower off the interest only payment or the fully amortized payment?
That is a good point, yes. So we will qualify them off the interest only payments. So if we're not at that 1-to-1, but we're slightly below, might be an option. Throw it on interest only and get it to the 1-to-1. And the reason I'm saying get it to the 1-to-1, we're still offering them a loan below 1-to-1, but maybe they really need that 80 or 85% LTV. There's also a rate hit if it's below 1-to-1. So maybe, again, if it's just adding interest only, gets you to the 1, that gives you the higher LTV and a lower interest rate. So good point on that. We also allow up to 6% seller concessions. We'll do warrantable, non-warrantable, and condo tells on this program. We get a lot of non-warrantable condos here in Florida. I'm not sure if Chris gets as many in his territory. Yes, he does.
Yeah, you're definitely in the mountains.
Yeah. Oh, yeah. True. True. So, you know, let us know why it's non-warrantable. If it's 100% investor concentration, I'm fine with that. Open litigation, but it's small slip and fall or something like that, not against our unit, doesn't affect our unit. Again, give us the details. We could be fine with that. One of hard stop that we don't allow is one entity owning more than 20% of the complex. And I'm sorry if you can hear that. My lawn guy just decided to mow my yard right in front of my window, so I apologize for the noise.
So as Stacy, what she said there is really where our hard stop is if one entity owns 20% or more in that complex. That's kind of a hard stop for us. But I will say in the past, I've got an exception if it depends on how much that 20%, how much over that 20% is. And if our borrower is buying it as a primary, I know we're talking about investors here, but if our borrower is buying it as a primary, you know, what does that do to the concentration of that one investor? So, and then Stace, just talk about, you know, how we do business purpose loans and.
Yeah, because these are our business purpose loans, we have 12 states that you can do these loans in without being licensed. Just check with your company, your manager, make sure that they're okay with it. But we do allow you to do these loans without being licensed in those states on those 12 states that are bold print there at the bottom of the left-hand side of the screen. So if you have those, you can start marketing in those areas as well.
We just added we're investigating another 17, just so you know.
Oh, good. I hadn't heard of that. Awesome.
Yeah. And I know we're going to talk about, Chris is going to talk about the 1003. I know Stacy touched on it a little bit here. We got a lot of great questions coming in here, so we're going to get to them, I promise. So Chris, talk about, I know Stacy mentioned it a little bit, just as a couple bullets here, but just talk about what you want to see on the 1003 and more importantly, what you don't want to see on the 1003.
Sure, and just so you know, we pre-approve all of the loans first before they go to underwriting, so we get a chance to look through the loan. You can use us, you know, as a reference for anything. The 1003, of course, is, you know, the most important document in a loan, and it gives you the chance to interview the borrower. And when you go through, you know, there's a lot of points that we look for that in the pre-approval that's helpful. One of them that we don't look for is the employment and the income, so you want to leave that off the 1003. We don't look at debt ratio. That's one of the reasons this is such a great loan, why we're probably getting a lot of them, being that they're priced very similar to Fannie and Freddie. But overall, you know, we want to see the borrower's owner occupancy experience, you know, where they live, if they own or rent, how long they've been doing that is really important, and how they pay their payments, if they, you know, pay a mortgage or if they pay rent. We want to talk about that. The REO schedule is really important to know, because like Stacy said, if they're in an LLC or corporation, we're not going to see that. But if they have loans in their personal name and they have mortgages that appear on credit, but many times those mortgages don't appear on credit. So what we look for is really that if it has a lien, that the lien is paid on time. We don't look at the, you know, the ratios. We just look at the actual payment history on the loan is really important. And then we want to see the assets, you know, that they're going to use to close, sometimes for reserves, although we do allow cash out for reserves in many cases. So the most complete 1003 you can get without employment and income is really important. You send that to us and we'll talk to you about how you send it to us in a pre-approval. We look through that to make sure it fits. We look for any, you know, for example, like I'm in Colorado and I get a lot of rural properties. So, you know, we want to look at the actual property too sometimes, vet that out. and just make sure it's a solid pre-approval. So.
Yeah, so we got a lot of great questions coming in here. So Stacy, talk about the LTV and how many units, the max LTV will do, and how many units we will go up to. I know you mentioned we'll go up to an 85% LTV.
So we'll go up to 85% LTV on a 1 to 4 unit. So I know a lot of lenders will hit the LTV based on it being a multifamily. We will actually go to the full 85%, 1 to 4 units, condos, non-warrantable condos, condo tells we do limit to 75% LTV.
Yeah, I think that's big, Stacy. Now, if you're looking for an 85% and you're trying to cash flow at a 1-to-1 ratio, that's going to be hard. But if you're buying a 4-unit property, the odds are you're going to probably cash flow greater than a 1-to-1 ratio. So I think Daniel asked that question, so hopefully that answered your question. Chris, you may have to look at your matrix. It's no shame. Tony's asking, what's the max LTV cash out refinance that we'll do?
Cash out refinance, we can do 75, I think. Let's see, cash out 75 is the max. Yes.
Yeah. So yeah, it's a lot of, a lot of questions are coming in here on short-term rentals. So let me just, I'm just going to address that here. I know Tony was asking about short-term rentals. If you have a 12-month, if you do have a 12-month history, and if there's a couple months without that, we'll take your 12-month history from AirDNA or VRBO, and we'll just divide it over that 12-month period, right? But we're not taking 75% off of that, 25% off that, or using 75% of that. So that's some of the things we do. But lately, there has been a lot of chatter behind AMCs and using short-term rentals, right? So they're getting away from that because there's some litigation out there where they can be litigated against for retro using short-term rentals. So there's a lot of, we're using AirDNA. We're trying to work on our occupancy rate on that. So more to come on that subject. So there's a lot of moving parts on that. So if you have a specific scenario, again, we'll have your AE reach out to you specifically on that. So a lot of other great questions coming in here. Gift funds. Stacy, you mentioned gift funds. What type of documentation do we need for gift funds? And don't go into your 30-day season, please. But so.
Yes. So gift funds, we just need the gift letter, and it can be any gift letter. The one that you print off your LOS system is fine. And then proof that the gift doors funds went to either title or to our borrower's account. We do not need the gift doors bank statement. I know that comes up a lot. So just proof of the wire transfer into our borrower's account or to title and the gift letter.
Yeah, thank you, Stacy, Sandra. Hopefully that answered your question. Chris, I've got a question here from Stephanie. In order to be considered an experienced investor, do you need to have held their investment property for a specific time? And I think that goes back to, what Stacy mentioned earlier, Chris. Do we allow first-time investors?
Yeah, we've never had that guideline or that restriction. So, which, I think we would prefer them to have a primary residence. And, I think that's probably what we consider more important than anything. So.
Yeah, and we do look at rapid acquisition. So I do want to come full circle on that question. So if someone's just purchased, 3 investment properties and looking to purchase their 4th or 5th within a 6-month period and doesn't have any experience before that, we're going to ask some 2nd and 3rd level questions on that. So just to be full disclosure there. Stacy, Lori's asking, what are the reserves again, please?
Yes, it's 6 months reserves just on the subject property. And Chris touched on it as well. If it's a cash out refi, we can use the cash out towards reserves. And also if you don't meet the full 6 months reserves, ask your AE for an exception. If you have 4 months, 5 months, exceptions are here to be made. We're not black and white. We're not a run DU and see if it fits. Everything's got an exception based to it.
Yeah, Stacey, and that's one of the bigger ones we do exceptions on, whether it's 1 or 2 months less than what we're required. That's one of the frequent, uh, uh, what did I just say? Frequent.
Exceptions.
Thank you.
One of those days.
Yeah, thanks. Chris, talk about, Stacy touched on the interest only. I think her name, Theory is the name, is asking about the interest only and how it's interest only, I guess, for how many years, and then what does it amortize to?
Yeah, so, we'll do interest only for the first 10 years. And then on the investor cash flow, I think it's 30 years. I believe I'm right. So it would amortize for 20 after that first 10-year time period.
Correct. Yep.
And, keep in mind, again, that we qualify on the interest only payment. Sometimes that can help you, if you're really close on your ratios. So it's really important. Also, just overall for an investor, it's a better cash flow situation. So.
Exactly. We're seeing, just to give some people some data here, bank statements is our #1 product, right? And it's always been volume wise, and it had been unit wise. What we've seen over the last 6 months is bank statements are still our #1 product volume wise, but unit wise, that debt service coverage ratio has become our #1 unit. And I really believe it's that investor who still believes in real estate and the quickest way to accumulate wealth. And they're not worried about where rates are. They're like Chris says, they're either going to do interest only for cash flow, or when rates, if and when they eventually do come down, they'll refinance. So I think that's, again, I know Stacy, you've seen it, Chris in Colorado, Stacy in Florida, homes are appreciated at a rapid pace. So,
and I'll say just real quickly, like years ago, it used to be maybe 10%, maybe 20% of my pipeline. It's much higher now, double.
Oh yeah, for sure. And also too, John, I kind of wanted to touch base. Like you said, a lot of investors out there, a lot of people that own investment properties, I just kind of want to reiterate, if we're doing a refinance, we can use your current lease to qualify for this program. So we are not subject to using the appraiser's estimated market rent on a refi. Purchase, we do have to use what's on the 1007 from the appraiser, but on a refinance, we can use their current lease and proof they've been receiving that lease amount for the last 3 months. Or if they short-term rent it, give us their VRBO and Airbnb printout for the last 12 months, and we'll average that. And a lot of people, if they're putting it on Airbnb, they're also putting it on VRBO. Get both of those statements or any other platform that they may use. Get all of those statements, and they'll give them to you. Airbnb will give you the 12-month printout, or they can go on their website and print it out. We divide by 12, add it to the VRBO printout, divide that by 12, and get our monthly market rent that way.
Yeah, that's big, Stacy. I think you answered Rick's question regarding refinances. But Stacy, I'm going to go another step deeper for Rick. Is when can you use the appraised value?
Yeah, that's a good one. So we only have to have seasoned 6 months. So once the borrowers own the property for 6 months, we can use the appraised value on a refinance. If they've owned it less than 6 months, we can still refi. Like I said, maybe they want to recoup their cash or pay off a private. We'll just have to be subject to using the purchase price.
So, Joseph is asking here, and I'm going to bring up this, we have a DSCR calculator, debt service coverage calculator. Let's talk about, Chris, let's give us some examples, Chris. Let me know if you can see that, Chris.
Yeah.
Yeah, give some examples of the 1-to-1 ratio and even the break even or just a negative cash flow, if you don't mind.
Well, just in a rule of thumb, if your rent, is $1,000, our mortgage payment has to be $1,000, so it has to be even or better. The rent would be, higher. Once it falls below 1, then we have the second tier, which is 0.8. So the rent in that case, would be $800 against our $1,000 payment. And then if it falls below that $800, it's a no ratio.
Yeah, so hopefully that gives you an idea of how those ratios work and what we consider a 1-to-1 or a 1 to a +1, and then down to a 0.9. But I also want everyone to know we'll go down to that 0.8 cash flow, but we'll even go below that. And as Stacy mentioned earlier, it's a no cash flow program. So, we have an AE on the East Coast. He calls it a bulletproof loan. If your borrower has the funds, this deal is going to get closed. So. So Stace, will you do a cash out refi on a property owned free and clear?
Absolutely.
Yeah.
And again, if they've owned it for at least 6 months, we'll use the appraised value. If they purchased it for cash, we can still do it using the purchase price.
Yeah. This question. Stace, talk about insurance, Stace. I'm going to go to you on this because a lot of this is in Florida and stuff like that. Talk about what we look for: reserves, insurance, and all those things rolled put in a nice little bow for us here. So
yeah, so insurance right now, you guys, I'm sure, have all noticed deductibles are getting higher and higher. They're trying to keep the insurance costs lower for the HOA, which I get. We'll go up to a 10% deductible on insurance, and that's on any of our programs. We'll go up to the 10% deductible, which is great. And the only thing that we don't allow, which I'm seeing a little bit here and there, is cash value for roof replacement. It does have to be it does have to be on RCE. It cannot be an actual cash value on the roof.
Okay, thank you, Stace. Chris, I'm not sure if you know that we do a decent amount of condo tells. What's the minimum square footage on our condo tells?
450. And I believe the other change we made is we don't have to have like a full oven now. I think it can be like a little kitchenette. And I see these a lot in the mountains. So, and I get some, I see they're 300. They're really low. But that made a big difference when we lowered it to 450.
Yeah, it did, Chris. And Stacy, talk about, I think maybe someone didn't believe you here. What's the max LTV we'll do on a fourplex?
85%.
Yeah, so that's 85 on a purchase. On refinances and stuff, I think we're down to that's what a 720 score, that 85. I think refinances and cash outs, we are at 75, 80 with a 700 score. So, yeah, it's a lot of great questions. Go ahead.
80 be a rate and term, but cash out's going to be 75 max.
There you go. Okay, someone asked me to put the states back up. Here they are. So the states that you are allowed to lend in, if you are not licensed in, are those 12 states below: Colorado, Florida, Georgia, Indiana, Louisiana, New Mexico, Ohio, Oklahoma, Pennsylvania, South Carolina, Washington, and Wisconsin. And as I mentioned earlier, we're working on another dozen to a dozen and a half states there. And as Stacy mentioned earlier, if you're not licensed there, that's fine, but you need a letter from your company allowing you to close that loan in a state that you are not licensed in. So, so hopefully, Bill, hope that helps you out. Chris, talk about the AirDNA occupancy rate right now that we have.
Okay. Yeah, AirDNA, we got to have an occupancy rate of 65% or higher. We also have to have a market score over 70%. AirDNA, again, I get a lot of questions about how we look at income, and a lot of people don't even know it exists. It's a really great tool for short-term rentals. Pretty accurate, and you can see in every market in the United States. Usually, there's a report on the property. So.
Yeah, and I would tell you right now, if you had an AirDNA at 60 for occupancy rate of 60 or above, let's talk. Let's talk, because I think that's one of the ones we're going to really, the occupancy rate is where we're trying to expand that that bucket a little bit more. Stacy, talk. I know you talk, and probably the worst person I could ask this question to is talk about where funds come from. But how do we look at crypto? Stop, Stacy. How do we look at cryptocurrency? So.
Funds can come from anywhere. No, I'm just kidding. So funds can come from
Sweating.
your. We only season funds for 30 days, people. So as long as they've been in the bank for at least 30 days, we're good. Now, if there's a large deposit, we're going to ask to source it. But if we wait until that we get the next bank statement where we don't see the large deposit, then we're in the clear. Now, as far as reserves go, we can use anything, 401k, mutual funds, IRAs, and you don't have to liquidate them. Now, if you're trying to use IRAs, 401ks for down payment or closing costs, then we have to see that they've been liquidated. But if you're just using those type of accounts for reserves, you can leave them in there. They don't have to be liquidated. As far as crypto goes, that does have to be liquidated, even if you're using it for reserves. I actually ran into that recently because I didn't realize that we were going to have to liquidate it. But I guess it's because of the fluency of the crypto and how liquid it is that they want to see that actually liquidated. So we can use crypto. They just have to move it to their checking savings account prior to close.
Thank you, Stacy. Hey, Chris, this is a Ken's asking a good question. So, client owned a home for 2 years and has put sweat equity into the rehab property, and his money is hard money, and it's due in a month. Property is empty. Can they still use a 1 ratio? He plans on using it for Airbnb. How do we look? Let's dissect this question a couple of ways, right? A lot of the business we get, Chris, comes from hard money, right? So people trying to refinance out of hard money. But talk about if a property's vacant, if they're just refinancing it, or they're trying to do cash out.
If it's vacant, we're going to give it a no ratio. If it can get occupied, a lot of cases we'll take the lease and rent. So it's best for them to try to get it rented. But again, we have a bulletproof loan. It's a no ratio, and there's still a loan there, which is great. So.
Yeah, so I've got Tom and Michelle wanting to jump already to the marketing portal. Tom and Michelle, we will get there. I promise you. We're about almost 20 minutes left here. So we've got a lot of great questions still coming in. But Chris, let's jump to foreign national, because we are seeing an uptick a little bit in this, and we'll still answer some questions, but I want to make sure we talk about our quick quote tool, how to submit a pre-qual, and then most importantly, how to market these programs. So Chris, talk a little bit about foreign national and maybe just the philosophy on why we roll this up under the debt service coverage ratio program.
So the foreign national market is great. We even have it in Colorado. A lot of foreign nationals buy condos and property up in the mountains. Remember, it is a foreign national, so it's a citizen in another country who does not live here and is purchasing a property in the United States. And we felt it best to be under the debt service coverage ratio to limit the documentation, to make it easier to qualify for them. They're buying property for that reason. They're buying it for their kids to go to college. Around the world, people view the United States as a great place to invest in real estate. So it's a great product for that. We recently increased the loan to 1.5 million. We have a minimum loan of 100,000. We allow you to do a purchase, cash out, or rate and term. Again, it's an investment property. One unique thing on this DSCR is it has to ratio 1 or better. So keep that in mind. And again, the borrower cannot reside in the United States. They can close in an LLC. That's permitted. Assets, really important, have to be seasoned 60 days, but they can be in the United States for only 30 days. So keep that in mind. We require 12 months reserves, and they can remain in the borrower's own country too. Yeah. One of the things to always keep in mind are the visas. So Up on the screen there, you can see the types of visas. Always check with that. When we look at the pre-approval, we usually look for that. We also don't allow gift funds. But this has become a pretty popular product, and it's a great one to market. Don't let it get confused for like an ITIN or maybe a non-permanent resident. This is truly a borrower that's a citizen that lives outside of the United States.
Yeah, so Chris, I'll let you, so obviously those are the eligible visas here. We have highlighted here on the screen, but talk about the visa waiver countries and what we require from them.
Yes, so there are visa waiver countries like the UK where you don't have to have the visa. And I'm a little fuzzy on what we require on that one.
It's just a valid passport. That's all.
Yeah.
So if you're a Canadian, you have a valid passport. We do a lot. You probably see a ton, Stacy, down in Florida. But yeah, we just need a valid passport. I think there's 32 or 33 countries that are visa waiver countries, and all we require is a valid passport. And as Chris mentioned earlier, was with all this political strife going on in the country, you're seeing a lot more people wanting to have assets here in the U.S., and that is in real estate. And before we get to the marketing portal, I'll put this out there. Around large universities, you see, foreign nationals, because they're sending their children here to study abroad, and they will buy, whether it's a single family house or a condo here, and, their child can live in it for the 4+ years that they need to be here. So, Stacy, talk about prepayment penalties. I forgot who asked this question. It's a really good question. We didn't cover it.
Yeah, that is. So our investment properties, any investment property on any program, and also, of course, the foreign national, because it's an investment property, we have a standard 3-year prepayment penalty in states that allow prepays. It's a standard 3-year. They can buy it down to a 2-year or a 1-year with a hit to the rate, or they can buy it out completely for no prepay with a 1.5 upfront cost. So to buy it out completely is going to be an upfront cost, not an add-on to the rate. But if they want to buy it down to a 2-year or a 1-year, it is a hit to the rate. Or on the opposite end of the spectrum, they can go to a 4-year or a 5-year for a rate discount.
Yeah. So just trying to look at a few last questions before we move to the quick call. What's the max LTV on more than 4 units? Right now we're just capped at 4 units. So, but as we mentioned earlier a couple times, 85% LTV is the max, even on a 4 unit. Okay, let's skip to, I think I have Stacy. Stacy, you're going to tell us how to, because we talk about pre-quals, everyone's like, okay, how do I get rates? How do I do pre-quals? Chris mentioned it briefly that, we do this all up front. So Stacy, let's go back to the home page and take us through how to submit a pre-qual. And this is also where we're going to get rates.
Yeah, so you guys do not need login credentials for this step. So where you're going to do is go to our home page, which is angeloakms.com, and click on right where John has his cursor, right in the middle of the home page where it says non-QM quick quote. When you click on that, you have your channel type, which is a broker, which most of you are going to be broker. Your first lien, you're going to enter your loan amount, your credit score, and we're going to use the mid score. Your loan to value, the state that the property is in, your housing history. Here's where you can change it to 1 to 4 units or a condo. No,
talk about what, and I just read, I looked at this last night before come here today, was we allow a 1 times 30 on your mortgage on this program. That's impressive.
Yeah, and if you have, like, say it's somebody that has a bunch of rental properties and maybe you have 2 times 30, bring it to your AE. Again, we make a lot of exceptions here. So maybe there was a blip, maybe they were out of the country that month and they had 2 loans that went 1 times 30. every loan has its story. So, let your AE know the story and see what they can do if it doesn't fit the box. We like to work outside the box. So you can keep down, the property type, that's where you can change it to 1 to 4 unit, condo, condotel. So we'll just leave it on 1 unit. Purchase, rate and term, cash out. There's where you'll see the delayed financing. Full doc, you want to change this to DSCR. Very important. Now, when you do that, if you look up above, wait, go back up, John.
Oh, sorry, Stace.
You're good. So when you change it to DSCR, go up right underneath your state. It'll ask you if you're licensed. This comes into play because of those 12 states that we allow you to do loans in that you're not licensed. There's no difference to rate or LTV. It's just asking the question. All right, so now the DSCR cash flow defaults to 1 to 1.0. If you're doing a purchase, we really don't know what it's going to come in at until we see that appraisal. So I like to leave it on 1 to 1.1. Now, if you know it's going to cash flow low, you're more than welcome to change that.
And Stacy, as an AE, aren't you looking up like Zillow and for the Zestimate and stuff like that when you're looking some of this stuff up just to make sure, you're helping your loan officer out?
Yeah, I do. Sometimes Zillow has rent estimates, Zestimates, they call them, on there. Sometimes they don't. So I'll try and see if I can find it there just to help out. If it's a low loan amount or certain areas that like Chris mentioned around universities, or like John mentioned too, if it's a multifamily, that it's probably going to cash flow. So it'll default to U.S. citizen, 30-day lock, which we're closing in less than 30 days, by the way. Prepayment penalty, this is where it defaults to the 3-year. You're welcome to see what the rates are, and that's what's so great about this quick quote. You can change this at any time and recalculate your rate if you want to do a lower loan to value or a higher loan to value or a different prepay penalty. That's what's amazing and awesome about this quick quote. It's so easy to use. So you'll see the investor cash flow, that's what we call DSCR. Our LTV requested was 75 up above. But according to what John entered, you can go up to 85 with the scenario that he input. The rate shows you 7.249. Now we want to actually look to see if that's going to cost anything. So you want to click on that blue button that says view rates. So the 7.249 that it mentioned on the first page is actually giving them a 0.5 point lender credit. So it's $2,000 towards the borrower's closing costs. Now, if they're adamant they want in the sixes, they can get 699. It's only going to cost the borrower $2,500. So, and that's, obviously subject to whatever loan amount you put in. But you always want to click on that view rates and view that rate stack. See what you want to get. Now, to send us a pre-qual, you'll just bubble in an option and hit select option. This is going to ask you for the 3.4. Most LOs don't even know what that is, so just hit next. And now here's where you're going to select your account rep. And then you're going to enter in all of your information, your company, your name, your NMLS, phone number, borrower's name. And then in the next box, you can just drag and drop your PDF version of the 1003 credit report. And then down below, you'll see comments. If there's any comments that you want to tell your AE about this, hey, they had a short sale, it's not showing up, but it was 6 years ago. Or anything that you want to say, hey, I want max LTV. I put in 80, but can you get me to 85? Anything that you want to tell the AE when they're doing your pre-qual. And then you hit submit, it goes right over to us, and we'll have your pre-qual out to you same day.
Yeah, Stace, and the additional comments, usually sometimes if you've had a conversation with someone, it might have been a day ago, it's nice for them to put those comments in there. Hey, we talked about this borrower, has been living, has been renting, but owns other properties, and they might not be showing up, but I think this is a great thing. Stace, around how long is it taking you to do a pre-qual on debt service coverage ratio?
DSCRs are so easy. I mean, I'll have them out to you, unless I'm doing a webinar, I'll have it out to you within an hour or two,
Yeah, yeah.
but definitely same day.
Yeah, so again, Stacy mentioned it a little earlier, your AE is your confessional booth. They love to try to make deals work, but in the same time, they're also saying, I'm going to make sure that nothing comes along with this. So they might be asking you second, third, fourth level questions along the way. And it's really just to preserve your referral relationship and your borrower's relationship with you. So again, with the experience we have, not just on this call, but across the country, there's a large percentage. I think Stacy one time said you got 100% pull through or something like that. It's really comforting knowing that you have this type of account executives working with you on your behalf. So, anything else regarding pre-qual, Stacy, or rates or anything else like that?
I mean, it's that easy, guys. Honestly, if you've never done a non-QM loan, they're very easy. Don't be scared. We will walk you through it. We'll hold your hand the entire step of the way. We've made our portal very easy to use, very user-friendly. We'll be happy to get on calls. We have tutorials. We have videos on how to submit a loan, how to order an appraisal, 2 to 3 minute videos or step-by-step instructions, or pick up the phone and call the AE and we'll walk you through it. We can do it as we're driving in the car. It's that easy to do. So don't be afraid of non-QM, even if you've never done one before. They're super easy. Great way to put more money in your pocket, just to grab a couple non-QM loans a year. You're going to increase your bottom line, and they're definitely worth it. I think a lot of us are going to go see a lot more non-QM in years to come. So if you're not on board doing them now, now's the time to get going with them, because they're really easy to do, and let us help you.
Yeah, Tom was asking a question here. What was it, Tom? Do you have a list of the visa waiver countries? If you just Google visa waiver countries, they will all come up. So Tom, that should help you there. And I know Tom and Michelle, I think, were the ones that asking, how do you market these programs? Who do you market them to? Someone else asked about a flyer. I know we're about 8 minutes left here. So Chris, let's talk about the marketing portal and how you work with your loan officers to help them market themselves to not just debt service coverage ratio borrowers, but to any other borrower like self-employed and stuff.
Yeah, so we can do a number of things to help you. I mean, our job is really to help you market these products. So whether we go out with you to do a presentation or whether you do one, social media, we want to try to give you the resources to help. So once you log into our portal, we have a marketing portal basically where you can customize your own flyers, put your logo on them, and help you navigate these programs with your partners, your realtors, for example. I've definitely gone out and done realtor presentations with my partners, and that's been really successful. We will always be kind of anonymous, like your investor partner, if you want us to be, but maybe just more like the industry expert. But ultimately, we're here to help you sell these products, to try to do more of them, because once you start doing one or two, you start getting referrals, you start getting confidence, and building, just start building from there, and we want to help you do that. So once you get into our portal, there's the marketing tab right there, and we're clicking on that, and we can start with the flyers. We customize these flyers for all of our programs. You can kind of see the thumbnails there of the different ones, but we have product specific. We can do, we have one that just talks about all of our programs, and if you're just marketing investment properties or foreign national, we can help you with that, where you can put your information on there as well.
Yeah, Chris, I know we're in a kind of a test environment on this portal, so it runs a little slower than normal, but as you can see, the drop down, these are all flyers, and if you just put in your information, your contact information for one, it populates every flyer in there.
Right. And again, you know, we're here to help you with that too. So, you know, please use us as a resource. Um,
Here it comes
I
finally.
know one thing I know for sure, when I've been in realtor presentations, usually one of the realtors themselves, you know, want to end up doing the loan. So it's really a great place to start, and that's a great audience to work with.
It really is, Chris. I always say, if you know, we know how many realtors close our bank statement loans. It's 9%, right? 9% of the loans we close on our bank statement program are realtors. We don't know how many close it in our debt service coverage ratio, because guess what? We don't require job or income information. So I would imagine it's at least, I would say, double that. So yeah, so this is the flyer, Chris, you know, finally popped up here. So
Also financial planners, you know, attorneys, you know, if you really want to work partners, these flyers can be helpful too. You know, could sit in their office and when they're meeting with their clients, you know, they can refer to it.
And you can co-brand these too. You can put in your logo, and then if you're doing a realtor presentation, put the logo on it too. They'll
Yep.
think that's pretty nice of you to have their information on the flyer, and you can leave them with a stack of them. It's free. It's free to you guys. So co-brand them, put your realtor on there, or like Chris said, your builder partner, whoever you want to co-brand with, put their logo on there on the flyer.
yeah, like you said, Stace, this stuff is for you. I've seen these co-branded at open houses, right? You know, it's just, it's really, you know, and again, we've got them there for self-employed borrowers, investors. You know, I think it's Eric Morgans that says, how do you find a self-employed borrower? Well, open up your front door, you'll trip over them. I do have a account executive here in Dallas. I'll just share this with you. He went out one day and Googled how many real estate investment groups there were in the Dallas-Fort Worth Metroplex. He stopped counting at 20. He actually went with one of his loan officers to one of those group meetings, and majority of the investors in that meeting did not ever hear of a debt service coverage ratio program. So get out there and Google in your area who is doing investment club, a real estate investment club, any real estate investment clubs, and join it. Come as a guest speaker, talk about this program. Bring Stacy, bring Chris, bring whomever. Chris, let's talk about some of the other great marketing tools we have here.
Yeah, so we also have presentations. That's really important. Just like I said, when we attend them, or whether you do them, we have them customized. Especially the realtor presentation is the most important one. It's just designed to teach them about the product, you know, give a little overview of the market, and become, you know, an expert in this business, in this non-QM business. Really helps you along the way. You can also customize it for yourself. So
yeah, Chris, I've seen people who do an entire presentation. They might talk about their FHA, their VA, their USDA, all the stuff that they bring as to that client or to that realtor, and then they'll also talk about the non-QM section, and it's all in one presentation. And as Chris said, you know, he will go in there. He'll just say, we're one of your investors. They don't say anything about Angel Oak. So I think that's really powerful when you bring a Stacy or a Chris to a realtor presentation, and they can talk about these programs, you know, like their second language to them or their primary language. It's pretty powerful, and it shows the support that you have from one of your investors. So
then we have, you know, social media, you know, is a big way to market these days. We can help you, you know, with the same type of thing as like a flyer, but we have images, that flyers that, you know, you can put on social media, and they're very informative too. So we want to help you exactly the same way that we would with a flyer, but, you know, via social media. So
yeah, I think we have enough content here that you could probably do a marketing campaign for at least 30 weeks out of the year. You know, whether it's on social media, flyers, realtor presentations. I just think we've got a lot. Stacy, I know you do a lot of realtor presentations. Do you have anything in addition you want to share? I know we're getting near the top of the hour here.
Yeah, I just know that they're really great. So if your AE's local, grab them. If it's not an in-person, do a Zoom or a Teams webinar with them. They're great, and they always love guest speakers. So definitely grab us and we'll help you out and hopefully increase your bottom line.
Yeah, so Stacy, while you're on a roll here, talk. What would you share in closing here today?
Just how easy these programs are. And again, lean on your AE for guidance. We're here to help you. We don't get paid unless the loan closes, so we all have the same goal in mind. So lean on us. We'll definitely want to help you get these loans closed, show you how easy they are, and I guarantee after you've done one, you're going to want to go out and start marketing them and do more.
And Chris, in closing.
In closing, now obviously rates are pretty close between a Fannie Freddie loan and our loans. Our loans are just easier to do, just for that alone. But we make exceptions, and we can tell you if we can do the exception or not upfront before you go to underwriting. I think that's really important to know that you have a solid loan before it goes to underwriting.
Yeah, Chris, and the other thing I meant to bring up during the debt service coverage ratio, we're not asking for tax return or lease agreements on all your other properties, right? We're just qualifying off that subject matter property. But, on our website, we call these underserved borrowers, right? Innovative solutions for underserved borrowers. I truly believe our marketing portal is the best in the industry. And I do believe, unfortunately, it's an underutilized portal. And I would challenge everyone on this call, don't say I'll get to it. Really work your marketing plan, get ahead of it. We've got other AEs who say if you market this for 60 days, you will start building your pipeline on day 61. So I thank you. I know we're about a minute past top of the hour. Thank you, everyone who participated today. We had a lot of great questions. I know we didn't get to them all. This will be sent out before end of day tomorrow. If we can get to your questions, we will have AEs reach out to you. But on behalf of everyone here at Angel Oak, if you've closed a loan, thank you for your business. We really do appreciate you. If you haven't, give us a chance. I want to thank Stacy, Chris. Thank you very much for giving your time today and more importantly, your expertise to our audience today. Everyone, have a great afternoon and a great 2025. Thank you.
Thank you.
Thank you.